What is up? This is the Working Investor. In this video, we're going to compare and contrast two cryptocurrency themed ETFs that pay weekly dividends. And the two I'm talking about is BLOX ETF from Nicholas versus the famous LFGY from YieldMax. As always, nothing here is financial, tax, legal, or any sort of advice. This is purely for fun and entertainment purposes only. Please see all my disclaimers. So, of course, you guys know I'm going to look at the charts when I compare these two. Now, I think it's important to look at the since inception chart from the most contemporary ETF, which was BLOX ETF, which came out 6/16/2025, which is and then compare it to LFGY and Bitcoin as the benchmark. And you guys can see right here that BLOX is a beast. You know, total return is 16.9% versus LFGY, which is just a measly 1.24% versus Bitcoin, which is 9.25%. End of the video, all full stop. We have the answer. Who's the winner, right? Well, not really. There's a lot more to the story, a lot more nuance. I actually own both of these funds, so I'm not really overly biased one or the other. I just like how each fund works. Again, that's just me. That doesn't mean that I'm giving you any financial advice or anything. You look at the 5-day chart, you have a little bit of a different picture because Bitcoin went down a little bit in the past week. BLOX is down pretty hard, 6.06%, LFGY 4.17%, Bitcoin 1.4%, relatively speaking. We're going to go over the option overlays and in a little bit more detail, and we're going to compare the secret sauces between these two funds. And I was actually shocked when I saw some of these option plays. I do have a video of BLOX ETF where you want to hear everything in detail. I'll link it in my description. Essentially, three components of BLOX ETF. There's the Bitcoin Ethereum exposure. They're not necessarily Bitcoin. They're basically blockchain technology, hence blocked. They also have the crypto industry companies, so your equity companies that trade off, crypto. They will do well. They're part of the crypto sphere. And then they give you weekly income, guys, weekly income, right? But not just the income. Look at this last paragraph right here. The primary investment objective is to seek capital appreciation. The fund's secondary investment objective is to seek current income. I feel like this was literally talking to me because I'm looking for capital appreciation, total return, number one, and then income, number two. But give me some capital appreciation and give me the income. I want my cake and eat it too, right? Who doesn't want to have their cake and eat it too? As you see, 6/16/2025, that's the magic date. The expense ratio is 1.03%. And you guys can see the payouts on the website. It's about 14 to 16 cents roughly since inception. And of course, they pay on a Monday. Guys, let's go pop the hood and take a look at their holdings, right? So now let's look at their equity positions. They have Hood, Coin, NVIDIA, Riot, HUT, XYZ, TSMR, MSTR, Circle, HODL, FBTC, ETHA, BMNR, right? And then now I kind of had to organize some of these positions to make it together. So, I don't have to jump up and down the page. It make you guys dizzy. Let me give you guys an example. So there is Galaxy Digital Inc., right? Ticker symbol GLXY, right? Currently the price took a dive, right? It's $28.89. Let's take a look. Look at the 5-day chart to see what I'm talking about. Look at that nosedive from $29 all the way, bam, $25. Bam, this thing got killed. You can see here a staggered put credit spread. So here is the holding, the share amount, 53,217 shares is what they own in equity. And then you see two put credit spreads. All these put credit spreads are expiring on Friday. Now you can see here, negative means a sell and a non-negative means they bought. That's what I understand. So you can see here a 249 contracts that they sold of 31 strike price. And then you see here 249 contracts they bought a 29.5 strike price. So the spread of this put credit spread was $1.50. So it's a defined risk trade where the maximum loss is $1.50 per contract or $150 per contract. And they're losing right now because it went down. It blew past this whole side. So they staggered it. They have, remember, it's trading, let's say 28.89, let's say. So they have another one where they have a short put on the $28 strike price. And then they have a 283 contracts. And then they have against that a long put 26.5 strike price. Again, the difference between $26.50 and $28 is $1.50, and that's $100, $150 because you have to multiply by 100 per each contract. So that seems like it is still okay-ish. I say ish because it looks like it's in between this put credit spread. So, that's where you get all this premium because, these are very volatile companies, but this is one position, right? And remember, this has been a bit of a nice, bittersweet week this past week in crypto. So look what happens. But the point I want to make over here is in the equity positions, you don't see any calls. So you don't have any, see if the market goes down, right? Your underlying position right here, these shares, they go down in value. But if you're overall bullish in this company or in this whole sector, then you don't care about the noise that's happening at the moment. Except for the contracts, because they hurt, because they're going to cost you. But other than the contracts, the overall long position, the 53,217 shares, that's all just noise. If you think that, if you're uber bullish and you think crypto in general is going to go up with great positive drift, then you don't have any capped upside. You go down, then you go back up. You may have to have some scars with these losses, unless it turns around before the Friday, or unless they close it out or roll it or whatever. But there's no capped upside. So that's one layer, right? But then you'll see I put in blue the calls, and the calls on the equity portion, which I'm referring to the middle line, crypto industry companies, which you saw, they just do put credit spreads. Sometimes you win, sometimes you lose, right? And then we see where it says the first line, Bitcoin plus Ether, there you're having call credit spreads. So you're kind of designing a iron condor of sorts. An iron condor is a type of strategy where you have a call credit spread and a put credit spread, and you're deriving income on both sides. Now the market can be up and down. It's either, you can lose on both. You're either gonna blow past the put side or blow past the call side, or it'll stay in the middle and both sides will be a win. But you can't lose on both sides. So one side's always definitely gonna win. But of course you have risk on both sides. That's where you have premium. So it's doing a sort of like an iron condor, not exactly. It's doing on the theme of Bitcoin, of cryptocurrency, because they're on, like you see the middle line right here, they're doing put credit spreads and the only underlying. So they're overall bullish. And on Bitcoin and Ethereum, they're doing call credit spreads, which I'm going to show you again in the spreadsheet. Let's focus on the blue boxes with the red writing. So look at FBTC. I think it's Fidelity BTC, right? And you see C for call, the $105 call, right? Now you don't see a negative. So they basically they bought a call at the 470 strike price. At the 105 strike price. 470 is the contracts. And here they sold 470 contracts at the 101 strike price. So they have a 101 strike price, which they sold, and they have a 105 strike price, which they bought 470 contracts against these 470 contracts. So and I would assume that FBTC is trading at the $99.15. So that means that FBTC can go, if it's below 101, you're still safe. We have a couple dollars that we could, with some wiggle room over there. Again, so scenario one, the crypto sphere really shoots up, right? Yes, your call credit spreads are going to get challenged and you may have a loss, right? Your put credit spreads and all your equities are going to be fine. They're going to be full profit because they're going to be, you're not going to be challenged because it's going up. and your core position you have is going to go up. So if there's a market correction and then the market just bounces up like crazy, you may suffer a little bit on your call credit spreads because you're getting income from the call credit spreads. There's always a trade-off. But on your put credit spreads and on your long position, you will rally up with the market, nothing holding, you know what I mean, holding you back on the equity positions. Again, read the prospectus, and they always say that they may not necessarily do what the prospectus says. I don't know. You have to. I'm just as look at watch the interview that they had with Income Architect. I'll link it again in my description, and look at the prospectus and come up with your own conclusion. If you guys have not fallen asleep yet, we'll get into LFGY from YieldMax. So LFGY, boasts a distribution rate of 67%, more or less. Well, that based off the most recent distribution. So let's say somewhere in the 60s, right? And then the other one is, we said like 36, I think that's what we said percent, somewhere in the 30s, mid-30s, mid-60s-ish, sort of. So it seems more compelling, right? But you saw earlier the total return since inception of BLOX, which is the more contemporary fund. But again, we haven't seen long history, so it's in its infancy. And here you can see the weekly payments. It's 47 cents, but don't look at the 47 cents. Look at the percent yield because it's a more expensive per share fund, right? So I know idiots that just look at, oh, this is more, this is less. No, everything is about ratio and percentages. That's all it's about, right? It's not about stock price and everything. It's about the ratio and percentages, all that matters. So are you guys picking up on this little nuance right here? Look at this fund overview. LFGY is an actively managed ETF that seeks, current income and capital appreciation. Notice they said current income first and then capital appreciation. And they talk about direct investments. I like that because that means like not necessarily like synthetic. It's more like they own the underlying. So how do they get you the income? By writing options, contracts and all. Now look at this, you're going to see this. Writing option contracts in some or all of their portfolio companies. So actually they don't necessarily, and I'll show you soon, they didn't actually write on all their positions. You guys can read all the rest. But again, here it just doubles down on this, right? It says primary investment objective is to seek current income. Secondary objective is to seek capital appreciation. It's secondary. It's flipped over on blocks, if you noticed. Now, this fund came out January 13, 2025. Also pretty new, right? It's like 7-8 months old. And expense ratio is just about the same, 0.99%. I think blocks was 1.01. So it's just, splitting hairs over here, right? Net assets, I think blocks was 25.7 million. This is 185.36 million. So it tells you about liquidity and, the reputation in the market. All right, guys, let's go pull up the spreadsheet with all the holdings. I know, guys, it's a lot of words, but I was going through this back and forth. This is a public service, right? And are you guys seeing, look at this row right over here, right? That's where you see call versus spread. So you see, for example, you could see BitDeer Group, right? And you could see here are the shares they own, right? Look carefully. And then you could see here call, you see C for call, C for call, C for call. I don't see any puts. I don't see put credit spreads. I don't see callers. I don't know. Maybe I have it. Maybe I downloaded it at the wrong time of the day. That there's some other trades that were not listed. I have no idea, guys. But look at this. So BitDeer, they have 542,653 shares. The price is around, let's say, $12.98. And then you see here, if you add up 1310 plus 4116, it's about 54, right? About 54. It should add up about that. So now you see here, now look very carefully. Check this out. So it's trading at almost $13, just under $13. So they have a short call for $14.50. And that's 4,116 contracts of that. And then they have a long call, And this all expires this Friday, 8/8, right? A $16 strike price. So this is about $1.50 out of the money, right? Tidal does the same. Tidal does the trades for, I think, BLOX and of course for Yield Max, which is Tidal. They merge into one, right? So I see similar $1.50. Now here's the golden nugget over here. The amount of options that they have in the long call is exactly the same amount they have in the negative for 116. So now my question is, what is this 1310 contracts at the 13.5 strike price? And it looks like they sold. So that basically looks like to me like a covered call. So they have a covered call, 1310 strike price, contracts. Now, if you go up a row to just put a decimal 2 digits over, so pretend it's so it's 0.53. So a max amount of contracts they could do would be 5,426 contracts. 5,426. But they only are writing cover calls on 1,310. So I don't know, 25% maybe is a covered call. So they have a covered call against this position, which they own. And then in addition, they have a further out of the money call credit spread, right? That's what it looks like to me. A partial, so a not fully capped, only 25% capped, 75% uncapped on the position, covered call, and a call credit spread. Cover call credit spread. That's what I see over here. And if you go through all these positions, you go through one by one. This video will be 2 hours long if I went through every single one. But do you guys see puts anywhere? All I see is call, call, call. Actually, no, I do see a put. Hold on. All right, so I looked it up. So MBTXW, I believe, is Bitcoin mini futures of Bitcoin. And it looks like they have a put credit spread going on over here. They have a 150. So the MBTX, which is a CBOE mini Bitcoin futures, is trading around $268, right? So you have these long out in expiration, December 23rd, it's December 31st, 2025. You have a long put of 230, which they purchased, 2736 contracts. And then they have a short put, which is further out. So it's like a put debit spread, or it's like a, it's like a put debit spread. That's what it looks like to me at the 150 strike price. And then closer to expiration, which is a couple weeks out, they have a 295 short call. So it's a call credit spread and a 320 call. So they have this call credit spread with a put debit spread further out in expiration. I'm not sure exactly what they're doing there, I'll be honest. But other than that, keep looking down. I don't see any other puts going on. I just see underlying. I see, let's say, block, for example, right? So you see 97,654 shares. So they could do 976 contracts maximum. And you see blocks is trading, let's say it's trading around $76.12. So they have a Friday expiration. They have an $83 strike price where they sold 976 contracts. And they bought at the $6 wide spread, 976 contracts at the $89 strike price. So that's just a call credit spread. So I see call credit spreads, and I see basically cover calls. Sometimes they're not fully covered. Sometimes they are covered. So I see a whole combination of call credit spreads, cover calls. But where are my callers? Where are the protective puts? I don't see the protective puts. Like I made a video on Ulty, which I'll link, where you do see the protective puts. So where are they? Maybe it's just one day and I'm judgmental. Maybe I got to see what they're doing on different. Maybe they took them out of place. Let me know what you guys think with these strategies. Which one do you like better? Am I just looking at one snapshot in time and I'm not seeing the full picture? This is the Work Investor over, and I hope you guys have a wonderful trading week. Be well, all the best.